Hi, Assalamualaikum. Very good morning. So now I will continue with the next video, still under topic 3 of AUD689, which is materiality. Now, what do we mean by materiality? It comes from the word material, something which is important. So by definition, given by the International Accounting Standard, it means the magnitude of an omission or misstatement of accounting information that makes it probable that the judgment of a reasonable person relying on the information will be changed or influenced by the omission or misstatement. So basically, the keyword is something which is very important, because when it is not there, the omission or any misstatement of the accounting information, it will actually influence another person's judgment. That means when they are going to make a decision, he or she or the person actually relies on this information. So if this information has been omitted or there are misstatements in the accounting information, that will actually affect a person's judgment. Again, materiality is a matter of professional judgment, so it depends what is material. For a layman, normal person may not be the same as another person. But when it comes to performing our audit, there will be certain rules that we are going to be using as a benchmark to determine whether something is material or not. Now, there are 3 steps in applying materiality. First, we need to establish a preliminary judgment about materiality, and then we determine the tolerable misstatement, how much misstatement that we are willing to accept, and then last one, estimate likely misstatements and compare totals to the preliminary judgment about materiality. So at the beginning of our audit, we will make some estimation. But at the same time, we also determine what will be the tolerable misstatement. There are certain leeway that we are willing to take. Lastly, only we are going to compare whether our preliminary judgment and the actual misstatement which could have occurred. Now, concepts of materiality need to be viewed in many ways. Okay, the first one is by definition. Just now we have talked about it. It means material information when the misstatement could influence economic decisions. That is what we have been talking about in previous slide. Something which actually influence a decision by another party. Okay, another one would be materiality is an auditor's preliminary estimates of the smallest amount of misstatement that could be material to the client's financial statement. So again, as we said just now, it is a judgment, because we don't actually know, not only until towards the end of the audit, but at the beginning, at the planning stage, we are saying that this is my estimation, preliminary estimates. Okay, the third one is that materiality is the criteria used by the accountants and auditors in distinguishing between unimportant and important matters. So one is material, another one could be immaterial. So auditor is responsible to determine that the financial statements prepared by the management are free from material misstatement. We are not saying that there will be no misstatement, but we are saying here that free from material misstatement. So only immaterial misstatement is acceptable. Okay. Immaterial misstatement due to error, not to fraud. I want you to distinguish between the two. And then if material misstatement exists, so what we have to do? We have to alert the management. We have to alert the directors. Yeah. Sometimes in certain companies, they leave it to the accountant or to the account assistant to prepare, and these people actually could have colluded to be involved in a financial statement fraud. So if we are aware of such situation, we need to alert our management, our clients management, the top management as well as directors, so that they can take certain action. And so they can take certain action, rectify the situation so that the accounts actually give a true and fair view. So we as auditor can give a true and fair view opinion on the financial statement. This is what I said just now. The accounts cannot be perfectly accurate, so we allow small errors. But then how do we understand about it? Okay, understanding allows auditors to use sampling techniques. So we can actually perform the audit job at a reasonable cost. It is not possible for us to do the 100% sampling. Okay, what do you mean here? Sources of material misstatements are errors and fraud. Errors is something that unintentional, so we can accept such situations, small errors. But fraud, even if it is a small amount, then we need to alert the management and an action need to be taken. Okay, look at this part. I talk about relative concept rather than absolute. That means, okay, for example, a misstatement of 1 million would be material for a small company, but may not be so by a large company like IBM is no longer here. This is an old example. Let's say Microsoft. Okay, 1 million misstatement. Perhaps this is not a material amount in terms of amount. But for a small company, 1 million is considered as very much a material item and something which we need to address. I'm not saying if Microsoft have a misstatement of 1 million, we need to ignore the situation. No, they still need to take action. But what they are trying to say here is that in terms of effect to the whole financial statement, perhaps for the small company, it will be more obvious as compared to the small company. If at the local concept, for example, if we have Petronas compared to a small oil and gas company who's making maybe only 1 million per annum, as compared to Petronas who's making billions of money, so like 100,000 misstatement to Petronas would be like 0.01% of the profit. But for another company who has only 1 million revenue for the whole year, like 100,000 of misstatement, that will be almost, that is already 10% of the revenue. So that's how we make comparisons. That's why it says relative concept rather than absolute. Okay, we need to establish or set certain basis in evaluating the materiality. Okay, it says here that because materiality is relative, therefore it is necessary to have basis for establishing whether misstatements are material. For example, we have profit before tax or net sales and total assets. These are examples of bases that we normally use as our primary base. Okay, auditor may decide that misstatement of profit before tax of 100,000 or more will be material. So the materiality threshold also can be expressed in terms of percentage on basis selected rather than absolute amount. So maybe we will say if there is more than 10%, 5%. So we will see later how do we determine this. Okay, the quantitative base for materiality is percentage, typically 3 to 5% on total assets, total revenue, income before tax, income before continuing operation, gross profit, or 3-year average of income before taxes. And then we also have the quantitative amounts be adjusted lower for qualitative factors. For example, first year engagement, or maybe due to control weaknesses, management turnover, high market pressures, high fraud risk, higher than normal risk of bankruptcy. So we are not looking only at the quantitative basis, but we are also looking at the qualitative factors. So this is what I'm talking about just now, quantitative guideline. Basically, there is no official guideline on quantitative measures, but the materiality threshold, this is what is being normally practiced by the auditor. Turnover is 1%, PBT 5 to 10%, total asset 1%. Let's say if we have a misstatement on profit before tax and that is amounting to 7%, so we have to decide whether that is considered as material or not. So of course, if it is 7%, it's in the middle between 5 to 10%. That's what is given in the materiality threshold as we have in the table here. So we are saying that it has actually become a material item that we need to address it. Okay, looking at the qualitative factors, which is also considered as important. For example, amount involving fraud. This is considered as more important than error. Okay, for the same amount. Okay, for the same amount, let's say if error is 1,000 as compared to this 1,000 is due to a fraud, then we consider that as more important because fraud is actually reflects the honesty and reliability of the personnel involved in preparing the accounts. So we are saying that if the amount of misstatement is due to fraud, this is considered as a much serious matter as compared to misstatement due to error, because error is being performed unintentionally. But fraud is something that you intentionally perform the situation. Okay, second point, small amount of misstatement could be material if bad consequences arising from the contractual obligation. Okay, for example, here I put here in granting loan to the company. Okay, for example, the bank required the company to maintain sufficient net working capital. So if the net working capital is less than the required minimum amount, even though in small amount, any misstatement could be material because this may put the loan into default situation. So because this is the rule that have been set by the bank. Okay, the third point, misstatements that are immaterial may be material if it affect a trend in earning. For example, for the last 5 years, earning has been increasing 5% per annum for the last 5 years. Every year we have increased 5%. But for this particular year, income has declined by 1%. So any misstatement may be material to maintain the trend. So we need to have, again, before we can actually pass certain judgment, we need to query the client and we have to find the reason for it. Like for this year, because of COVID-19, we will expect a lot of companies to have actually have a deduction in the profit. So that is something which can be explained because of the economic situation at this period of time. Okay, misstatements that are immaterial but may be immaterial, but we still need to disclose in order to comply with the disclosure requirement. Okay, as I said earlier, there's no specific rules or standard in providing or determining the materiality. Again, it is based on professional judgment of the practitioners. Okay, so let us look at the guideline here. Combined total of misstatement in the financial statement exceeding 10% is normally considered as material. Combined total less than 5% is presumed to be immaterial in the absence of qualitative factors, while combined between 5 to 10% requires greatest amount of professional judgment. So it goes down to professional judgment in making decisions. Okay, the second last slide. It says here, professional judgment is to be used at all times in setting and applying guideline. So as a normal guideline, 5 to 10% must be measured in relation to the appropriate base. Many times there is more than one base to which misstatement should be compared. So we are looking at several bases. For example, if the income statement, combined misstatement in the income statement should be ordinarily measured at 5% to 10% of the PBT, depending on the size of income for particular year. So depending on the client's company. As for balance sheet, combined misstatement need to be evaluated for current assets, current liability and total assets, usually between 5 and 10%. So for the same as what we applied for the income statement. So I hope you get a better idea So the relationship between audit risk and materiality, we shall discuss this in our tutorial.